Ready to get engaged to a VC? Then you better understand what a term sheet is, what it isn't, and how it can play a huge role in getting the investment you want. Today, I'm going to walk you through what a term sheet is, the role it plays in raising money or making an investment, and the key terms you need to pay attention to. Stick around to the end and I'll show you how a term sheet can be a huge tool for creating massive FOMO as either an investor or a company. So let's dive into it. So the basics of what a term sheet is. Just like in your own personal relationship, before you get engaged, hopefully you sit down with that person and you talk about who's going to work, who's going to take care of kids, where you're going to live, right? When are you going to get married? How many kids you're going to have? Like all those basic things. Well, and it's the same thing between a VC and an entrepreneur, because once the VC invests, it's kind of like you're getting married, right? You're partnering with this person for quite a long time. And so the term sheet really lays out how that relationship's going to work. It talks about what's the valuation, how much is going to be invested, who gets to make decisions, all those different pieces. And just like in your love life, once you accept that diamond ring and get engaged, it's a little bit harder to back out, but you can still do it. Same thing with term sheets. You can still back out of a term sheet, no big deal. But once you walked across the aisle, it becomes really hard, right? And say I do, it becomes really hard. Just like in VC, like once they've wired the money and the docs are signed, it's really hard to unwind those relationships. And so the term sheet can be a great way to define the relationship early on and then kind of test it out, do your due diligence on both sides. So let's dive in to what are some of the basic terms that you need to be aware of with a term sheet. So let me preface this first though by saying we can't cover everything. I wish we could. But one, there's not enough time in this video. And two, I'm not a lawyer. So nothing that I say should be construed as legal advice. But these are some of the things that are top of mind for me when I'm evaluating a term sheet. So the first one is all around the valuation. So valuation determines how much of your company you're going to give up for the amount of money that you're bringing in. And the way that this works out is you've got these two concepts called pre-money and post-money. And we're going to talk more about this in another video where I do a deep dive into valuation and how venture capitalists value businesses. But for now, the important thing is pre-money is the value of your business before you raise any money, and post-money is the value of your business after you raise the money. And it's a really simple equation. So if the VC looks at your business and says, hey, I think your company is worth $10 million and we're going to invest $5 million, then your pre-money is $10 million, your post-money is $15 million, and you just sold a third of your business for $5 million. So that's valuation. The next thing that you need to be thinking about is what are you actually selling? So you're usually selling equity, right? This isn't debt. Venture capitalists don't invest in debt. They invest in equity, but it's a certain type of equity. You could be selling common stock, but more likely you're going to be selling preferred stock. And preferred stock is very common for VCs because it allows them to tie certain rights and privileges to that stock when they make the investment. For example, when a VC invests, with preferred stock, they can put in place what's called a liquidation preference, which is another key term that you should be aware of. A liquidation preference basically is a downside protection for the venture capitalist. So if the company sells for a valuation less than the one that the VC invested at, they would get all of their investment back. So let's go back to my prior example of a $10 million valuation where the VC put in $5 million. Let's say things don't go particularly well, but you do find a buyer for your business for $5 million. Well, a liquidation preference would basically say that the investor would get their $5 million back first before anyone else would get any money. And so in that case, you sell your business for $5 million and the VC would take the $5 million to get their original investment back first. If you sold for 7, then they would take 5 and you would get the remaining 2. So that's the downside protection that VCs put in place. If you sold it for $3 million, they'd get all $3 million and they would actually lose money on that deal. It also allows them to put in different voting rights. So maybe they want a board seat with their investment, or maybe they want the ability to block you from raising more money without their consent, selling the business without their consent, hiring without their consent, right? Some different factors like that. Now, generally good VCs aren't in the business of taking control of your company. That's not what we want to do, right? We want to protect our downside, but ultimately we want to help you build the biggest, greatest business possible, because that's the only way that both of us make money. Okay, so other things that you should be aware of on a term sheet. So you should be looking at who's the lead investor. Now, the lead investor is typically the venture fund that is negotiating all these terms with you. It will spell out, or it should spell out on the term sheet, how much they are investing. But then you may have other investors that come in alongside them. For example, the fund I work at, University Growth Fund, all we do is co-investing. So we're coming in alongside other venture capitalists, and we might show up on a term sheet where the lead is XYZ venture fund, and then University Growth Fund and others are investing alongside them. You'll also have option pools, and we'll talk about that in another video, but option pools are basically pools of stock that are available for employees, both current and future. And so oftentimes they'll increase the number of shares that are available for new hires. There are oftentimes downside protection provisions like liquidation preferences that we've already talked about. There's anti-dilution provisions. So things like pro rata, right of first refusal. Basically what those do is they allow the venture capitalist or the investor to maintain their ownership in the company over time by having the right to invest more money. You could have control provisions. So I talked about those as well. So board seats, voting rights, protective provisions, etc. could be in a term sheet. And then hopefully it's got a target close date, right? So that this doesn't go on forever. It may have go shop or no shop clauses, which basically determine can you take that term sheet and go shop it around to other VCs or not. And it may have some other clauses. Now, ultimately, just like in your own relationship, you're not going to be able to foresee every little thing that you have to figure out in these relationships, and you typically don't need to. Same thing in VC. You want to hit on the high level things that really matter in this term sheet so that you can both come to an agreement, sign it, and then start working through confirmatory due diligence. Phew, that was a lot. And honestly, like, this video is not long enough to cover all those things, but we're gonna have videos on each one of them where we'll talk about in depth each of those terms and why they matter. Okay, so we got your term sheet. Where do we go from here? So let's talk a little bit about process. How do you go from dating to engaged to married, or in our case, funded? So dating, that's all about like meeting with the VC, getting to a term sheet. Just like in dating, it's like meeting with that other person, moving the relationship long enough to get engaged. Just like in dating, the more attractive the one person is in the relationship, typically the more power they'll have in the relationship. And so that same thing happens in venture. If you have a company that is absolutely crushing it, lots of VCs are probably going to be interested in your business, and you'll have lots of suitors. On the flip side, if you don't have lots of suitors and you really need to raise that next round of capital, the venture capitalist might have a little more power in that relationship. But the typical path is you'll go out and you'll meet with a whole bunch of VCs. I think when I talk to entrepreneurs, the average entrepreneur that raises a good round of capital has probably talked to somewhere between 20 and 40 different venture funds. And so you go out and you pitch a whole bunch, right? And really what you want to do is push them to give you a term sheet. So once you get the term sheet, now you're going to like negotiate back and forth on these different points that we talked about, right? The valuation, the option pool, how much money you're taking, downside protection, all those different provisions, right? So you'll talk through those different aspects of the deal with the VC, negotiate back and forth. Once you're generally on the same page, you sign. Once you sign that document, now you enter into confirmatory diligence. And at this point, most of that diligence is just confirming the things that the two of you have hopefully already agreed on. So the VC is going to look at your financials. They're going to look at your operating docs, your legal docs, and so forth. And they're going to confirm that everything is just the way it should be. And then once that's done, they'll also, at the same time, be working through your closing docs. But your closing docs basically take the terms of your term sheet and go 10 levels. And they're typically hundreds of pages long. You will definitely need an attorney to help you through that whole process. And that has a whole new level of negotiation back and forth. But once you get that all finalized, then you'll have a close date. All the investors that are coming in sign and wire funds on that date to fund the company. And now you're closed, you're married, and you're off to the races. So that's the general process that you should expect. All right, wow. So this is a lot of process and a lot of terms, but stick with me because we're almost done. Last thing I want to talk about is term sheets can be a tool for negotiation. They can be a tool to drive FOMO, and ultimately that's what you want. Fundraising is all about momentum. And so you need to create and you need to maintain that momentum, and a term sheet is a critical tool to allowing you to do that. Your biggest goal and your most important goal when you start fundraising is to push to get to a term sheet from pretty much anybody as quickly as possible, and then leverage that term sheet to drive others to submit them. So for example, if I meet with a company, they're like, oh yeah, like we're just meeting with funds and like, we'll see. And they have a meeting here and a meeting there, but they ultimately either can't get one of those to give them a term sheet, or it takes them a long time to get a term sheet, then what's being told to me, right, is like, this isn't that interesting of a business, right? Other people are looking at it and they're not that excited. Or even worse, that the entrepreneur doesn't know how to go out and fundraise. And like, do I really want to back an entrepreneur that can't raise additional capital in the future when they need it? So like all kinds of red flags. The flip side is the entrepreneur that goes out, they may have like 20 to 30 meetings and they're like, hey, they're telling all of those VCs like, hey, I'm having all of these other meetings. I'm expecting term sheets next week, right? Building momentum. That creates this like mentality of a little bit of FOMO. And then once a term sheet gets submitted, right, then it's signaling that back to everybody else of like, hey, we've got a term sheet, right? Like this deal is, what that signals is like, this deal is going to get done. Then everybody else is like, oh crap, like somebody else has enough conviction to jump on board. I'm going to submit a term sheet too. So how should you interact with investors as you're going through this process? One, be creative and don't be afraid to tell investors what you're looking for in your term sheet. So I don't recommend sending them your own term sheet. Like in a lot of negotiation, you kind of want the other party to make the offer first and kind of see where things set. But that doesn't mean you can't give them guidance. If you talk to them and you say, hey, we need to raise $10 million and we're looking to sell 10% of our company. Well, to the VC, oh, great. I know that you want a $90 million valuation on your business. And I can decide, like looking at the financial performance and so on and so forth, if that's something that I want to jump in on or not. If I think it's overvalued or undervalued or priced right. Ultimately, there could be other things too that matter to you, right? You may say, hey, valuation's important, but it's not the most important. Being able to have a big option pool might be more important. Or I'm willing to give on valuation, but I want you to give on, you know, some of the downside protections. But by providing kind of that guidance to the VC, that can allow them to also be more creative in terms of giving you a term sheet that really meets what you're looking for, as well as what they're looking for. If you're an investor, highly recommend that you use active listening to find out the real motivations and then customize your term sheet accordingly. I will say that like most of the time, the highest valuation doesn't win the terms. It's all of the other things, right? As long as the valuation is within the ballpark, usually entrepreneurs care about the partner that they're going to bring onto the board, the help that they think that they can get from them, and the other terms on the term sheet tend to be a lot more important. And so if you can figure out a way to address those things, then you can be a lot more successful in landing that term sheet. So I just want to touch on Tiger Global, because I think they have a fascinating approach to using term sheets, plus a bunch of other things that they do in the background to build FOMO on the investor side. Their strategy to building FOMO and winning deals is to hit the entrepreneur with the things that a lot of entrepreneurs care a lot about, but they don't necessarily get. So Tiger Global's like, hey, look, we're not gonna pretend that we are who we aren't, and we're not gonna take board seats. We're not gonna worry about control. We're gonna give you a high valuation. We're gonna move super fast. I've heard of Tiger closing in deals in like a matter of a couple of weeks, right? And that's like, they have a phone call, they make an offer on that phone call, and then they fund. They get all the negotiation on all the docs, everything done within like a week or two. They write big checks, so the company has plenty of money to operate. And Tiger Global has built this really strong brand, which is important because as an entrepreneur, if you have an investor with a strong brand, then that'll help you raise more money, hire employees, land customers, etc. So that's what they do. And the way that they pull it off is they do all of their homework ahead of time. So when they have that first call with the entrepreneur, they already know a ton about the company and they just need to confirm a few things and they can make an offer right there. That to me is like a genius strategy. Now, is it going to work 100% of the time? No, because in some cases they may overpay for a company because they pay high valuations and they don't have the control necessary if something goes wrong to step in and really make changes. But the flip side is that they're able to win deals and beat out other top tier funds for access to those deals. So wrapping this all up, if you want the best deal and you want to close quickly, then having a strong fundamental understanding of term sheets is absolutely crucial. If you want to learn more, check out my next video where we're going to talk about how to get a job in venture capital with absolutely no experience, just like I did when I first started. Thank you for joining. I hope this was helpful in terms of understanding process, terms, and what a term sheet actually is and what it isn't. And good luck as you go out and fundraise and land your own term sheet.